Hello, everybody. We're back with the Tokyo FinTech podcast. And today we welcome Luc Falempin, who is the founder and CEO of Tokeny, a security token platform. Bonjour, Luc.
Hi, thank you for having me.
Thanks for taking the time. It's about as much French as I will try out today. So you're a serial entrepreneur now. You had a different company before with a successful exit. How did you get to consider the security token space for your second company?
Several things. First, I booked my first Bitcoin in 2011 when I was trying to invest my 1,000 euros. I tried to buy some Google shares at the time and realized the fees were way too expensive. It was not super interesting. So I looked for alternatives and I discovered Bitcoin. So I tried and I realized the fact that you can manage your own assets with Bitcoin. So that was quite convenient. And also, and mostly with my previous company for 6 or 7 years, I was helping our clients, our customers to launch e-commerce marketplaces. So I was very familiar with this concept of marketplace, and I knew that it's very good to be the central player in the middle of the ecosystem. When I heard a lot about blockchain and how you can decentralize system, and it was very, very intriguing. And I really wanted to dig more and understand why it makes sense and how it makes sense, and how to reach this critical mass critical size you need to launch a network to make it relevant. So I started to work on that after selling my first company, started to travel, and without really noticing, 3 months later, I was building another company.
And how did the journey continue from there? What were the first steps and how did this evolve up to now?
So we started in 2017 with the initial vision of doing security tokens, so tokenizing real financial instruments in a compliant way. Of course, at that time, people wanted to do ICOs, so a new kind of assets, let's say, so utility tokens. And it was pretty complicated to use and participate into this offerings. We came up with a very easy to use and compliant solution to do token sales. We used my previous experience in the e-commerce industry to build some kind of shopping cart, basically, to participate in an offering where you could decide how much you want to invest, you do your KYC, and so on and so forth. So we started like that, very good traction. So we became profitable the first year. And very quickly, because we had the right initial vision, I would say, we started to make this initial platform evolve in the direction of compliant financial instruments. And since then, that's what we are doing. So we are now proposing a complete suite of solutions from the onboarding of investors, the issuance of the tokens, the management of the tokens and investors, the secondary market as well. It's very, very complete now. Unfortunately, the market didn't evolve fast enough, so we had to build a lot of building blocks, but now we're getting there.
What does the European landscape look like right now for security tokens? What are the primary markets for you to play in?
So it's very interesting because we started as an international and global company with clients everywhere for ICOs on 5 continents. And more we feel that it becomes more localized, where you have the financial centers. So basically you have New York, Paris, London, Luxembourg, Switzerland, and now Singapore and Tokyo starting as well. So in Europe, it's funny because we have the right regulations, the most advanced regulation for security tokens, basically saying that security tokens are securities and the same regulations apply. Pretty good. And you can dematerialize financial instruments, so that what you need basically to do security tokens. However, for the last 10 years, since the last economic crisis, banks and in Europe is very trusted by big banks. And these big banks have to face a lot of additional compliance rules, a lot of new things. Every year you have new regulation to follow. So it becomes very, very costly for them to apply compliance. And therefore, they are scared to innovate. They're scared to open bank accounts for their clients, to totally switch their system to a new infrastructure, a shared IT infrastructure, which is a blockchain. It's not that natural, especially because they spent billions for the last 30 years to close their system, to make them more secure. So it needs a lot of education before we can do something, but the regulation is there, right players are there. So I think it will become very interesting and tangible in the next few months, because I think the actual crisis is accelerating the change.
It's certainly a drive to digitalization all across the globe at this point, right? Let's break it maybe down into 3 components. One is the AML and KYC, anti-money laundering, know your customer identification verification and authentication. With all the global crisis as well, the thing that's really missing in many things is to have a transferable identification, right? An electronic ID, a digital ID for the players, whether it's a bank account or it's other government services that we're using. And part of your platform, you have developed a digital ID as well. Is that correct?
Yes, indeed.
And so how does that function?
When we started to work on this compliant aspect and how to transfer compliantly security tokens from one person to another, we realized that the main element was to verify if the receiver of this token is eligible for the security. The jurisdiction from where you issue the securities is important, but it's even more important where you distribute the securities, what type of investors you're targeting and where they are. We quickly realized that we needed to properly identify every stakeholder on the blockchain because we use a public blockchain. We say that you don't need to control the blockchain itself. You need to control what you do and what the other stakeholders are doing on this blockchain with your tokens. So we give an identity to every stakeholder, the issuer, to be sure that when a token is deployed, it's issued by the right person, the right entity. We give on-chain identities as the agents, so the KYC agent, everyone that is performing operation, and also on-chain identities to every investor. They have nothing to do. They receive it automatically. And this on-chain ID is basically a small smart contract. And in this smart contract, you have claims, type of information. And these claims are signed by trusted third parties appointed by the issuer. So basically, we bring the real world trust and we put it on the blockchain just with the signature, not the actual data on the blockchain, but just signature. So we have proof that someone you trust verified that information on the blockchain. And because it's on the blockchain, it can travel with the investors when they will connect on an exchange or when they will connect on their servicing platform or anywhere they will use their profile, their account. It becomes their own account. So it's portable with the investors, but also portable with the token. Because every time you have a transfer of token, we can check this eligibility rules and if everything is fine.
This is digital identity tied into your platform, or is it almost an independent product?
It's an open system, actually, because it's on the blockchain. So the smart contracts and so on are published. And even the smart contracts are based on standards as well, ERC 734 and 735, for example. So it's a standard. But of course, behind this proof on the blockchain, you need to host the data somewhere. So Tokeny is, of course, by default, one of the main hosts of data, but it could be any other agent as well.
That sounds exciting already. When we then look at the process, we obviously have primary markets issuance and then secondary market trading. As an issuance platform, how do you support people who want to tokenize an asset, whether it's an existing financial asset like a share or a bond or real estate or any other hard asset?
Tokeny is a technology provider. So we don't do advisory or legal or so on. So basically with our tool, you can tokenize what you want because we can issue a token and you decide what it represents, what kind of value it represents. Of course, we do our due deal on our clients. We verify it makes sense, but you can tokenize what you want with. And to tokenize, what we need is basically a list of investors, their wallets, and how many tokens they're supposed to receive. So of course, we have a lot of different options and we can do much more, but basically that's it. So we can provide this onboarding tool, so a cloud-based white label platform to onboard thousands of investors in a few minutes. But sometimes it's not useful when you have a private placement with 10 investors. So at the end of the offering, so it can be a periodic offering or a continuous offering for an open-ended fund, for example. All of this data, this collected data about investors and their subscription to your offering is going to what we call the T-Rex factory. So T-Rex is our security token protocol. And the factory is actually this product where you can deploy and allocate tokens to all of your investors and give them on-chain identities if they don't have if they didn't have one yet. So it can be fully automated or it can be done by a non-technical person on the interface.
And how long should I imagine does it take to set up a new token on that platform and make it ready for investor inquiries?
Most of the time, it's pretty quick because the T-Rex protocol is proven and it comes, so it's a set of smart contracts audited and so on. And you need all of these smart contracts to make it work anyway. You have smart contracts for ERC20 because they are ERC20 compatible. So with any normal classic Ethereum wallet. And you have additional smart contract to control the whitelisting. And we will whitelist the identities and not wallets. Otherwise, it's not compliant under European regulation and actually in most other jurisdictions as well. So all of the smart contracts are built in and will be deployed automatically. And depending on the offering, you can add additional smart contracts to perform other type of operations. You can, from day one, deploy dividend smart contracts or taxes or whatever you want. Most of the time, I would say 50% of the time, you have an additional compliance smart contract for the rules not related to investors, but related to the whole offering. For example, if you do a Reg D in the US, you cannot have more than 2,000 investors, so you need to cut that somewhere. Or you can have rules to forbid transactions, like no more 1,000 transaction amounts or that kind of rules for the whole offering. So it really depends the cases, but can automate this as well because we do the compliance smart contract once, and then if you want to reissue tokens with the same legal framework, it can be automated.
So if I transfer then tokens from one party to the other, as part of the transfer, the compliance contract is invoked and verifies whether that's actually a whitelisted target.
Exactly. For every transfer, validation check will be performed. So we have this whole validator system in the middle. So before the blockchain transaction, it will check if the receiver is eligible. So it will check if his identity is whitelisted in the identity registry, meaning if the receiver has an identity with the right claim signed by the right person. Basically, KYC check, but it can be much more information. And if the whole compliance rules are respected. If everything is okay, the transfer will happen. Otherwise, the receiver will be invited to go on the servicing platform to become eligible, so to follow the KYC process and so on and become eligible. And actually, that's one of our main competitive advantage on the market is that this validator system is on-chain. It's a set of smart contracts because the proof of identity are on-chain already. So everything is performed on-chain and the smart contracts belong to the issuer. So it's basically the issuer doing the KYC check and so on, the compliance verification automatically in a few minutes and on the blockchain. So even if Tokeny gets hacked or whatever, there is no issue.
Are you completely tied into Ethereum? What is if one of your clients says, I hate Ethereum, I want to build this on something else, on Algorand or EOS, for God's sake? Do you have flexibility to port it to a different protocol?
For the moment, we focused on Ethereum. Every month, we have an internal meeting to check if we should start doing something on other blockchains. We know the main blockchains very well, quite well actually. But so far, we didn't find much need to go on another blockchain, to be honest, because on Ethereum, the main value is that you have a community. So we are not reinventing the wheel every time we do something. We are building on top of this community by using tools with this community, and we help this community to grow as well. And I think that's one of the key advantage. And as well, you have a lot of wallets, for example, for Ethereum. We are looking at other blockchains, but we don't really see the main advantages. Sometimes it's twice faster, like Tezos. I mean, 2 minutes, it's better than 2 days for settlement anyway. Today it's T+2 most private market or T+5. We do it automatically in T+2 minutes. So if we can do it in T+1 minute, it doesn't change much. From my opinion, Ethereum is going in the right direction. There are some issues, gas fees or that kind of things that cannot be handled easily by financial institutions, but we have solutions. It's pretty easy actually to pay the gas fees on their behalf when they do a transaction. It's not that complicated. So for the moment, we didn't see the need to go on another blockchain. Most of our clients, they have no clue anyway. And what we see is this competition, which is still ongoing between permission blockchain, so private blockchain, and public blockchain. So we think it makes sense to work on public blockchain because you already benefit from this shared infrastructure. On Ethereum, you have 8,000 nodes. So it's resilient. The consensus is technical, so it works. It's not a consortium with politics and stuff. But when you have 10 banks in a room and you try to make them work on a private blockchain, you can wait a few years. It's exactly what happened actually. So more and more, we'll have this public blockchain and some additional layer, bring some privacy or to add like better performance or stuff like that. That's really interesting. We think using public blockchains is where we bring the value. Of course, you need to control and compliance on this public blockchain. But if everybody is starting his own network, we'll just rebuild what we have today and silo the system.
Yeah, and Ethereum certainly has the biggest ecosystem, both also in terms of the technical talent that you need to build it, as well as you said, the wallets. It's just interested, and you alluded to this in a comment somewhat. You're comfortable with the roadmap for 2.0 on the Ethereum side. It will take time to build it, but in terms of the steps that are taking, makes you comfortable as building your critical physical infrastructure on that.
I think it's going in the right direction, but it will change a lot of things. Like proof of stake in the US, does it become a security?
Also, Ethereum clearly still works from a volume perspective when you just have issuance or you've got private market transaction. When secondary market becomes a public market and you're aiming to ultimately replace exchange infrastructure, the volumes that we have on the equities market today, you wouldn't be able to represent on Ethereum in a timely enough fashion, right? So what is your approach to the secondary market? Where do you play today and how do you see that evolving?
From my perspective, Ethereum is scalable. Well, what happened with the cryptokitties is that it was overnight. So the system had no time to scale. So it was done in a few hours, but it was basically a DDoS attack on Ethereum. So any other system would have reacted the same way and blocked for a bit, for a while. So I think if this industry scales step by step, it will not be a main issue. So for secondary market on private markets, because we focus on private markets indeed. For public markets, you already have the infrastructure, you have intermediaries, it's costly, but it's actually quite efficient. And for private markets, you have nothing. It's very hard to find a counterparty. It's very hard to negotiate with this counterparty, very hard to settle with this counterparty. Everything is complicated and very costly because you need to involve lawyers every time you do something. So we think blockchain can bring this infrastructure. Compliance can be encoded on the on-chain identities of investors, the financial instrument itself is tokenized and on the blockchain. So we have the key elements. What is missing is the discovery part. How can I find a counterpart? After it's easy, you can settle on the blockchain. There are some smart contracts, some protocols to do the DVP and to guarantee to investors that they will receive the tokens they are buying if they send the tokens they have. So that's pretty easy. But how do you discover a counterparty? Someone else wants to trade with you. So usually you go on an exchange. But if you list your token on a regulated exchange, it brings some advantages for financial investors. Financial institutions like big investors, pension funds, and so on, they need that to invest. But you also have a lot of complication because if it's listed on a regulated exchange, in most jurisdictions, like in Europe with MiFID, it needs to settle in a CSD, custodians become mandatory. It becomes a real big thing. And therefore, you cannot list everywhere you want. It's only on a few changes and it's pretty costly to start and to operate. So you need big volumes and basically it's not accessible for most financial instruments. What we have done is that we consider basically the blockchain as the exchange and we have rebuilt every step. So the first step is compliance. We have on-chain compliance with the permission tokens, with the on-chain identities. So that's built in. Then you need an audience. And that's why we are building currently a network of bulletin boards, non-regulated. So anyone with an audience of investors can launch a bulletin board where you display trading intentions. And these bulletin boards are connected all together. So any operator of bulletin board can make some curation and decide its positioning depending on his investor. One can focus on green finance, another one on a region like Asia, another one on commodities or whatever. They are all connected together depending on their parameters. So when you create an ad on one of these bulletin boards, you can choose where it will be displayed in the whole network. When you find a counterparty, you can contact this counterparty and negotiate. So it's a bilateral discussion, bilateral agreement, and not a multilateral trading facility or basically not an exchange. Because it's just a negotiation peer-to-peer. And at the end, you decide that you will settle on the blockchain by using a DVP smart contract to be sure you receive what you're supposed to receive. So basically, you have these four main elements are actually booked by an exchange, but on the blockchain, you just leverage blockchain encoded trust with compliance, with this network effect and the settlement on the blockchain. You get the same results, except the transaction costs 50 cents.
And I mean, the bulletin board structure that brings us back to your previous company, it's very similar than your marketplace, right?
It's a decentralized marketplace. Like every player in this marketplace, every bulletin board has a right incentive to collaborate with the other ones. Because if you have your audience, but they cannot find any counterparty, there's no trade. So bulletin board becomes useless. So you can work with you can even call them competitors, like the other bulletin boards. You can work with other audiences of investors to be sure that your investors will get value from this.
I mean, even if I was listed on an exchange, but if I'm not a widely traded stock, then I would still need to have a liquidity provider. I would need to have a market maker who's committed to having bids and offers on. So is there space for this liquidity provider role in your architecture as well?
Yeah, so you can have market makers as well. And what is super interesting is that we're talking about digital securities. And the digital securities embed a lot of data. And this data is traveling with the token. So I was talking before about on-chain identities for the stakeholders, but we are also doing on-chain identities for the financial instrument. So the issuer can, for example, allow his auditor to sign on the blockchain the annual balance sheet, or to get, if they get a green label, for example, it can be signed by the right authority in the identity of the token, or if it's Sharia compliant. So it becomes way more easy and way easier to discover that kind of investment opportunities. Today, it's very hard to find good opportunities in green finance or Sharia compliance. If you have this global network where you can search depending of specific criteria, it becomes super easy. So it brings liquidity. So it's not market making, because then you need to define the price and you still have some other issues. But it's a huge advantage in comparison of traditional securities, where the data is somewhere on a piece of paper.
Especially the Sharia compliant market is huge, right? Lots of place for innovation. And in a way, it's like eBay, you're taking care of the long tail. So anybody who's got a specific interest, whether it's green or blue or yellow, if you cover a global marketplace, even kind of the outliers still become critical mass and tradable, right? That's a theory, at least.
Yeah, we need to reach a critical size for sure, but it's what the market is missing today. It's a place for the secondary market, and I don't think the answer will be regulated exchanges. We are backed by one of the major stock exchange group in the world, Euronext, so they are very aware of these opportunities of this new.
That's an interesting investment. You can take the view, well, it's great investment. It's one of the premier exchange groups, and clearly they will have done their due diligence on you. So that says something about the quality of yourself and your team and proposition that you're building. Everybody who's an extreme crypto maximalist would say, well, the purpose of this whole thing was to get rid of the stock exchanges and replace them with something that's decentralized. And now you're playing with the evil guy over there. The truth, like always, probably is somewhere in the middle. So how did this come about, and how do you feel? How tight is the relationship? Is this more of a financial investment, or is there management interaction? How does this operate in your case?
So of course we don't see them as evil, but I think a group like Euronext, they play with the rules, and the rules are very heavy. I mean, it's very hard to operate a regulated exchange in Europe. They are supervised by a special committee of 7 regulators. So that's why they have a bit more than 100 members who can trade directly on the exchange. Otherwise, it would be not manageable at all, not compliant at all. So it's not accessible because it's too complex, and you have a lot of regulation making it forbidden to protect investors. But now there's new technologies and blockchain where you can code trust and apply rules automatically, and these rules can be coded. It changes everything. Before you needed someone you trust. So the regulator needs to trust this exchange. So the exchange needs to prove how they apply rules and so on. The exchange needs to trust its clients. Banks needs to trust their customers, etc., etc. So everybody has to protect itself, and the trust doesn't navigate well between all of these layers. But with blockchain, it's flattening everything because it's directly in the on-chain identities and financial instruments. It's way easier to enforce this trust, to bring transparency to the ecosystem. So it's not because stock exchanges don't want to make their systems better or the world better. It's just because it's complicated to protect investors, and on the other side, to not have a lot of rules to protect them.
If you look at it from the company perspective, the companies that would want to create a security token or be listed in that form, the security tokens are securities, so security regulation applies. So as long as I remain in the private markets, then I still have limited reporting obligations. Is that correct? So it's only when I really do an IPO and that make it universally accessible to anybody on a public exchange that I have these quarterly or annual reporting requirements. It's more limited as long as I stay private.
Yes, indeed. If you become public, you have a lot of additional obligations. You basically need to publish all of your sheets and so on, a lot of details about your strategy, you need to give everything to the market so they can assess the risk and so on. However, for private markets, you still have obligations anyway, where you still need to respect corporate rules, regulations, and so on. So, but yes, it's still manageable because you're not public. And when you're public, it's a different story. You need auditors, you need a lot of, you have a lot of new obligations. And also most of the time, we're talking about equity. And I think it's very interesting to tokenize equity, but probably it will not be the first asset class that will be tokenized massively. Probably other asset class will come before, closed-end funds, for example, or debt, even carbon credits. I mean, super interesting. Equity, you already have processes, and it depends your size, and pretty quickly you can be listed on a regulated exchange. It's costly with a lot of, you need to prepare for a few years to do that, but it's possible if you're successful.
Yeah, the reason I asked this came from a conversation we had yesterday, and it appears that this was in Australia particularly. There were two companies who decided to delist from an Australian exchange, and one was about 160 million market cap, the other was 100 or so. And clearly it seemed like the burden of being a public company and the cost associated with that was deemed too high, and so they made the move becoming private. But if you then have, as you provide with Tokeny, a more robust infrastructure in the private market that still provides sufficient liquidity, it's a much easier decision to make. And so I'm wondering whether in the medium term we're seeing essentially the small caps disappearing from the public exchanges because it's so expensive, and you get really only the bigger sized entities that make that step.
Yeah, I agree with this vision. We will see how concrete it will become in the next few years, but we agree.
Is there a facility in any way to short sell on your markets? Can I borrow the shares somewhere privately and then sell? Is it just a matter of creating appropriate smart contract?
Quite early, to be honest, to see that kind of behavior, but with the securities, tokenized securities, you can do a lot of things. When you see the DeFi trends, the decentralized finance trend, and collateralization. I mean, they're dying for collateral. For the moment, you can use creepy or stable coins to borrow other stable coins. Very soon, you will have Bitcoins that you will be able to collateralize. But imagine if we can bring good security tokens, it becomes amazing. Today, if you invest in an apartment, okay, you get your rents every month, but your money is in the walls. The apartment, you cannot use it. Tomorrow, if it's tokenized, without any intermediary, you will go on Compound or other protocols and directly put your tokens there, and they will work. You will be able to borrow money to do something else in 5 minutes. It will change radically the behaviors. I think we're not there yet, but it's the direction we're going. They are basically smart securities, so high function securities. So I think people will be creative as always.
And so because they're smart, in your offering, you also had an asset servicing function. I was wondering, what are the activities that would be performed under that?
So we have something like 60 functions you can trigger as the issuer or the agent of the issuer. Operations such as minting new tokens. For example, if you just did a new fundraising, you need to create new shares. You will minting of token for a single person or for a batch of investors. You can also burn tokens, so destroy them. You can also freeze, partial freeze, forced transfer. You can imagine everything depending of what will happen. You can distribute dividends or revenues. However, if you want to automate the distribution of revenues, investors need to accept to be paid in tokens. So it really depends on the use cases, but we have many clients performing operations every month. Like we have one client, for example, every month as board members are with tokens, stock options plans for employees or that kind of things. It can be very interesting. So all of this is possible in the smart contracts, and then our clients manage them as they want. They can perform operations directly on the software, even if they don't have any clue about the blockchain behind and how it works. It's what we provide actually, this business workflows on an easy to use software, and on top of the blockchain. To perform something on the software, it triggers the blockchain action.
What is bundled under asset servicing is the pre-built function, and then the issuer decides what.
They can whitelist investors, for example, or blacklist one, or you have a lot of different operations like this that can happen on a day-to-day basis. And of course, they can track every transfer. So every transfer peer-to-peer on this decentralized marketplace will be tracked and directly visible by the issuer. So the issuer always gets the right cap table, so the dynamic cap table, and he can go back in the past and know exactly who were its investors at any point of time.
The way markets evolve, you always get the spot markets first, and that's the security token here in this case. Ultimately, there might then also be a derivatives market. Do you see that eventually coming for these security tokens as well? Is that part of your plan?
We are technology providers. Question is more, is it part of the plan of our customers? But yes, we have a few projects about derivatives. I think it's a bit early for the moment. We are still trying to have a good, serious assets on the blockchain. And I think when we have the basic type of assets, we can build on top of that and create more advanced financial instruments. Token holders need to be properly identified. So you need to be a legal entity. So you can be an individual person or a company.
Last question is, of course, how do you ultimately make money? What's your charging model for people who want to build tokens on your platform?
It's pretty simple. We are selling technology, so SaaS solutions. So depending on the use of which product you need and for how long, we charge the platform. So it's pretty clear. But we have I think it's 7 products now, and those products depend of your offering. If it's a periodic offering, meaning a defined subscription period, you need the onboarding. Then at the end, we issue the token with the 2x factory. Then we provide the servicing or the life cycle of the token, and then we have the secondary market after the lockup period. So you don't need the same product at the same moment, the same solution at the same moment. And sometimes for an open-ended fund or a marketplace or an investment bank, big asset manager, you need all of these products at the same time because them not for you, but on behalf of your clients. Theoretically, with our products, you can issue thousands of tokens a day automatically or manually. It really depends. It depends if you are a single issuer or if you are a big investment bank performing a lot of operations for your clients.
Your headquarters obviously is in Luxembourg, and you alluded to the US and Singapore and Tokyo or Japan earlier as well. When you look at the weighting of your business, how much of your business is European focused at the moment and how much of that is in Asia, for example?
So main business is currently in Europe, Luxembourg, Paris, Switzerland, London. But more and more we see we're getting some traction in Asia. So we have a presence in Singapore, which is like the epicenter to cover Southeast Asia. So we have clients in Malaysia, in Thailand, and Japan is a different animal, I would say. A very interesting market, quite big, but very specific. And there's a lot of interest for security tokens in Japan.
We've got the regulation coming out and being effective at May 1st, but everybody is still going through the regulation. I think it will take a couple of months until it's understood and then the first steps are taken. But it will be an interesting market, I'm sure.
Yeah, definitely, because you have all of this big consortium who want to access this new market, and tokens are a way to say that we could target smaller investors, clients, and automating operations and so on. So it will become interesting. You have some rules that will not change with this new regulation, like transfers will still need to be approved by the issuer. It would be interesting to understand if an automated validation, smart contracts would work or not. And also holders can only be qualified investors or with I think it's 100 million yens minimum, or a company with 50 million yens. It's quite close. It's still quite close for the moment. I mean, in comparison of Europe, an issuer can perform an offering up to 8 million euros per year and targeting retail investors without a prospectus. With simple legal documentation, can target retail investors directly up to 8 million a year. So it's going in the right direction in Japan. So very excited. We are trying more with some Japanese companies. We don't think we can go only by ourselves and start helping Japanese companies. We need some partners to be sure we bring the right technology and they can put it on the market.
Super, Luke. Any final comments?
Thanks a lot for having me, and very excited to see what's coming in the next few months. And we will try to make this crisis turn into opportunities.
Super. Thanks very much for the conversation. Super. Stay healthy, stay safe. Thank you.